Drew Hendricks here, flipping the script. Renee is on vacation, and
Mm,
I'm taking
yeah,
over.
he's actually studying for the broker's exam
Oh,
in
that's right.
California.
That's right. I, I thought he was having fun.
Yeah,
Anyhow,
yeah,
I am. He is probably having fun. I mean, what could be more fun than studying for the broker's exam?
totally. Hmm.
So yeah, Drew Hendricks here. I am sitting in for Renee. This is We Fixed Real Estate. Got Fred Glick on the line here, the host of the show. But man,
What
that
else?
is why I don't normally do this, but we're doing this unfiltered here. So today we're talking about Fannie Mae and the new loan to value.
Yeah, for multifamily. This
And
is
talk to me about this, Fred.
freaking huge, hugely. So if you want to buy I'm going to use the California example to make my point. If you wanted to buy a 4-unit property of which you were going to occupy one of the units and rent out the other three,
Mhm.
right now today, you would have to put at least 20% down. Fannie Mae changed that where you only need to put 5% down.
Whoa.
So on $1 million, you put $50,000 down, which can be 100% gift. Okay.
Mhm.
Which is amazing. Um, and then be able to buy the place. Um, I think, so like the 4 unit was 75%. So you had to put 25% down. Now you only need 5% down. So anywhere 2 to 4 units, you can now put 5% down. But here's the negative. The negative is you're going to have that private mortgage insurance.
Uh,
Nobody knows what the prices for the private mortgage insurance are going to be. So believe me, it's going to be an expensive interest rate. It's not the same as a single family. There's going to be premiums added on to the rate and to the PMI. But if the numbers work, the numbers work. Instead of buying a single house and having a $2,000 payment, you can buy a 4 unit and have a $500 payment because everybody else is making a payment for you.
yeah, as
It's
long as
pretty
the
good.
other renters can do the cash flow, you're
Exactly.
good.
So you got to take a look at all the numbers. Now, FHA has kind of been doing this up to 96.5%, but they've had this really expensive mortgage insurance. Plus, they have a harder guidelines for the property.
Like
And the thing
expensive
with
mortgage insurance. I'm only familiar with single family homes. What would PMI be for a multifamily unit?
we don't know. That's what I was just
Oh, okay.
saying. They haven't, the prices change and the PMI companies haven't set it out. So that's to come in the future a little bit. But as I was saying, the VA, you can even do the 100% on a 4 unit property. So if you're
Whoa.
VA entitlement, they don't care what kind of property you buy. So that's kind of been around. It's a tough loan to do because VA can be a little tough for property and some other weird stuff. And they have that uh, uh, VA funding fee, which is expensive, but it is what it is. It's financed in. That's good news. So there are ways now. It's going to open up more stuff for people to be able to buy the multifamilies. That's the good news. Okay, so here's the situation of why this is not as good as it seems. I'm always going to give you the worst case scenarios. That's just me. There's investors who buy multifamilies. Now there's going to be owner occupants.
Mm.
So you can see that, there's just going to be more demand. So I would say go and do this if you're going to do it as soon as possible, just to make sure everybody doesn't find out about it.
Mhm.
So, um, yeah, interest rates suck right now. They're high. They will be coming down. It may take 2 years, but if the bridge work now, it's going to work even better later. And then there's going to be more buyers because there's going to be more people who qualify.
Mhm.
So that's the other edge of this sword. So,
Well, let's
uh,
talk about interest rates for a second because you did mention that they're coming down, but they're still high. They're hovering just under 8 right now. What what does a home buyer or prospective buyer do? Or even a seller who may not want to sell out of their home at a 2.75 interest rate and have to go into a
yeah,
home at an 8?
well, the sellers, it's a case by case basis, but if you like where you live, you got a good rate, stay. I mean, up to them. I can't change anybody's mind with that. Look at the numbers and it makes sense for you. make sense for you. But you might say, hey, I'm tired of where I want to live. I need to move. I'm out of here. I only need one bedroom. I don't need seven. It's expensive for me to have it. You're going to go
Mhm.
regardless of the rates, especially when you're buying down. Um, but for home buyers, here's the story. We're in what's called the inverted curve. What does that mean? Well, the short-term rates, 3 months, 6 months, 1 year, 3-year treasuries are higher rates than the 10-year and the 30-year, which are called the long bonds, the long
Mhm.
treasuries. So nobody's really got adjustable rate mortgages out there to offer, even though fixed rates are high. Yes, there's some credit unions that may have it. You can check, but they're usually just pain to deal with and take too long. But for vanilla fixed rate, I think it was like 6.99. I saw the other day. We'll just use 7% to make this
Mhm.
example easy. So that would cost no points. So in seesaw method, you could get a six. You're seven at no, you get 6.5, but you're going to pay 3 points to get it. I'm just making up numbers. So if you
Mhm.
wanted to do that, you could get a lower fixed rate, pay the points, even maybe negotiate the seller to pay the points if there's nobody else negotiating against you. But as long as the seller nets the same, they shouldn't care. The points are totally 100% tax deductible for a primary residence in the year you buy the property, even if the seller pays them, which is really cool.
Mhm.
That's free money. Or you can do what's called a 2-1 buy down. You've probably heard this. So at that 7% rate, what they'll say is we'll give you 5% for the first year, 6% for the second year, and then from 3 through 30, year 3 through 30, you get 7%. Good news in this is, let's say you get the seller to pay the points, you get the lower payment for the first couple of years, 2, 3 years from now, the rate's going to drop. You refinance it, you're out of it. No harm, no foul.
One buy. That's good. Now, can people use the rebates for the
Oh
in
gosh,
the
yeah.
land sale?
You
So
can,
there's like a little hidden incentive there. You got the rebates, you got the what I'm just thinking here. You got the rebates, and then you've got
yeah,
the buy down, and you're buying these points with the rebates, and then those buying down those points is 100% tax deductible.
100%, Drew. You got it correct. And you're a layman in this, which is good. So yeah, use the rebate to get a lower rate for the entire term, or use it for the 2-1 buy down, or use it for whatever. We don't care. And it's not
Mhm.
taxable to you. You just adjust your basis for your capital gains. So it's a thing.
That's fantastic.
Yeah.
Well, as we're wrapping down this takeover episode, Fred, what's the good word?
Good word is I'm in Philadelphia, and it's like in the 60s in November.
Oh, that's
That's a good
nice.
word. Yeah, exactly. So, and I'm sitting outside, which is I normally don't. I'm normally frozen by now. So good weather here on the East Coast, at least for the next couple of days.
And I'm back in California, and we're finally getting actually like fall weather. We finally have the
Oh,
Santa
really?
Anas, so the surf's winds blowing offshore, surf's good. We had a
Oh,
really
excellent.
just it was just foggy as heck all through all through October.
Yeah, the surf's been terrible in the LA area. It's just nothing. A little
Yeah,
bit, but
we're in the sweet spot now. No, I was out
cool.
yesterday. It was great.
Cool. We'll do the surf report too next time.
Yeah. Right now
There you
it's
go.
2 to 3 offshore.
Nice. Nice.
Well, Fred, you go back and enjoy Philadelphia, and until next time,
Thank you.
this is We Fixed Real Estate.
Cheers.